Here is the overview of today's gold market news. Gold price performance, price trends, and technical outlook. Rising U.S. inflation and geopolitical tensions drive gold exchange-traded funds demand as investment focus shifts. Federal Reserve projections support gold prices amid economic uncertainty. Gold prices driven by central bank demand, geopolitical tensions, and global uncertainty. Let's have a look at the latest gold price performance, price trends, and technical outlook. Gold prices are holding steady above $3,000 per ounce, but analysts are warning that the market may be due for a pullback and consolidation. Despite a slight shift in sentiment, there is no immediate rush to sell gold, as factors driving its rise remain unchanged. Gold has the potential to move higher in the near term, with prices currently holding above $3,000 per ounce, with immediate support levels at $2,994 and $2,982. A drop below this range could extend down to around $2,950. On the upside, resistance levels are identified at the all-time high, with additional resistance at $3,025 and $3,050. To establish a sustained trend above $3,000, gold would need to hold this level, similar to the prolonged periods needed to establish trends above $1,000 and $1,000. Gold prices remain elevated above $3,000 an ounce, but are experiencing a pullback, likely due to profit-taking and concerns about deeper corrections. The psychological $3,000 level is a significant milestone, and such levels often trigger pullbacks in previous rallies at $1,700 and $1,800 levels. On Thursday, spot gold hit an intraday all-time high of $3,057.95, but the market has seen consistent profit-taking into the weekend. While the market is still supported by geopolitical tensions and economic uncertainty, it is running out of momentum, and prices may face downward pressure as we move into the latter part of 2025. Analysts maintains a 2025 gold price forecast range of $2,300 to $3,000 per ounce, with an average price of around $2,600 per ounce for the year. Geopolitical developments, sluggish retail sales data, and the upcoming April 2nd universal tariff deadline are causing market concerns, supporting gold's position as a safe haven asset. Strong central bank demand, along with growing exchange-traded fund flows, is supporting gold prices. The continued interest in gold as a safe haven against geopolitical instability and other currency fluctuations further solidifies its market position. Moving on, here are the updates on the rising U.S. inflation and geopolitical tensions driving gold exchange-traded funds demand as investment focus shifts. Inflation is a key factor driving investors to gold, as traditional safe investments, such as the 3-month money market funds, no longer offer real returns due to rising inflation and falling real yields. The U.S.-China trade war has also raised consumer costs, making gold an attractive alternative. There is increasing demand for gold-backed investments, particularly through gold-backed exchange-traded funds, which have been late to the market rally. In 2020, central banks' liquidity injections supported gold, but much of the capital also flowed into stocks, unlike today, where the focus seems to be on gold-backed investment. The current gold rally contrasts with past ones, especially in terms of gold exchange-traded funds demand. In previous rallies of 2012 and 2020, gold exchange-traded funds demand peaked as prices topped out, leading to liquidations as the global economy recovered. Analysts expect gold exchange-traded funds to be a major driver of investment demand for gold in the remainder of the year. Investment inflows into gold are expected to continue among institutional investors seeking portfolio diversification, especially if global stock markets face further corrections. Analysts forecast that gold prices will peak in the first half of 2025, but will remain supported throughout the year due to high volatility in financial markets and strong purchases by the official sector. However, as we move into the latter part of 2025, the investment case for gold may become less attractive as financial markets gain clarity on tariffs and U.S. economic performance. Gold exchange-traded funds have seen significant inflows, surpassing Bitcoin exchange-traded funds in the last few months. Bitcoin has seen outflows of $3.8 billion, while gold exchange-traded funds saw inflows of around $1.16 billion as of mid-March. Gold exchange-traded funds holdings increased by 3.88 million ounces this year, reaching nearly 86.7 million ounces, the highest since October 2023. The largest gold-backed exchange-traded fund, SPDR Gold Shares, has seen its gold holdings grow by over 37 tons this year, reaching 910 tons. However, SPDR Gold Shares holdings are still down 28% from 5 years ago, even as gold prices have increased significantly. In 2020, the holdings peaked at 1,278 tons, and the all-time high for exchange-traded fund holdings was in December 2012 at 1,353 tons. Next, let's look at the Federal Reserve projections supporting gold prices amid economic uncertainty. The U.S. inflation expectations have risen to 2.8%, up from 2.5%, which, along with tariff-related fears, could reduce real rates and lower the opportunity cost of holding gold. The upcoming Federal Reserve meeting this week is expected to impact market sentiment, and this may contribute to more price consolidation in gold. The Federal Reserve's neutral monetary policy stance and projections of 2 rate cuts in 2025 support gold prices. While the analysts do not expect a U.S. recession, the Atlanta Federal Reserve's GDP tracker projects a 1.8% contraction in the first quarter of this year, which could influence the broader economic environment. Moving on, let's look at how our gold price is driven by central bank demand, geopolitical tensions, and global uncertainty. Since the election of Donald Trump in 2024, there has been a surge in gold inventories at COMEX, driven by tariff fears and price disparities. However, the pace of inventory inflows has slowed recently. Despite the pullback, uncertainty in global markets and strong central bank demand suggests that gold may continue its ascent. Central banks will continue to buy gold and diversify away from the US dollar, as gold is seen as a safe haven asset in a world facing economic uncertainty and rising inflation pressures. Central banks have significantly increased their gold purchases, particularly since the Russia-Ukraine war in 2022. Central bank gold purchases have risen from 500 to over 1,000 metric tons annually, with major buyers including Poland, India, and Turkey. Gold remains an attractive safe haven asset amid U.S. President Donald Trump's America First policies and global import tariffs set for April 2nd. There is a risk of escalating trade wars between the U.S. and its key trading partners, which could heighten recession fears and increase demand for gold. Analysts predict that geopolitical tensions and economic uncertainty will eventually stabilize, reducing demand for safe haven assets like gold.